Corporate finance practice problem using Onenote. Buy new fixed asset or keep the old fixed asset decision-making process. Get ready. It's time to take your chance with Corp Finance. Here we are in Onenote. If you have access to Onenote and would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab, and then down in the 1243 Buy New Fixed Asset or Keep Old Decision tab. Also note, when using Onenote, take a look at the immersive reader. Many of our presentations up top will be down here in the text area as well, with the same name, the same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have the information up top. We're going to go through the calculation then on down below. This will be another comprehensive type of problem, but with another little twist to it this time. This time we have a decision-making process. Typical kind of decision-making process doesn't happen every day, but it happens from time to time, and it's going to be one of those that will affect multiple periods into the future, therefore requiring more analysis about it, that being whether or not we should keep an old asset, fixed asset, depreciable type of asset, or replace it with a newer asset. This is a similar kind of decision you might make on the personal side with a new car or something like that. Should I keep the old car or should I take on a new car? Now, on the personal side, obviously, you have the cost involved, but you also might be taking into account the amount of pleasure you might get in a nice new car or something like that, which can be a little bit more difficult to measure. On the business side of things, of course, we're thinking mainly directly on output, what's going to be the bottom line in terms of revenue. And we have the decision that complicates that, however, which is going to be the tax impact of it, because we're going to have tax impact related to it, and the depreciation is going to be another complicating factor as we go through it. So like with all the long-term decision-making processes, we typically want to get this broken down on a cash flow type of basis so that we can use our time value of money tools like the net present value, like the internal rate of return. However, and we need to then take into consideration depreciation, which is not a cash component, but an accrual component, which applies the cost of the fixed asset across the time period in which it's going to be used. So normally we wouldn't use that, but because that's basically applying the cost for tax purposes and therefore affecting taxes, which is a cash impact, we have to figure out what the depreciation will be and the impact on the taxes so that we can then do a good comparison, because the taxes will be relevant costs we need to consider. So let's first think about the old piece of equipment that we have. We're going to say that we have 5-year Maker's fixed asset already on the books. We purchased it for $75,000. We're going to imagine we already purchased it, so we didn't take it out for a loan or something like that. We purchased it, we're saying 2 years ago, we're going to imagine, and we could sell it at this point in time for $33,000. So that $75,000 that we got before, and we actually spent, we didn't get a tax benefit yet. We didn't get to expense it, which for taxes is a deduction, and get the tax benefit for the full $75,000, but only 2 years of it at this point when we're deciding whether or not to then sell that and purchase another one, which would be more efficient. So we could possibly get new equipment, which we're saying is going to be a 5-year Maker's fixed asset. This one we're saying is going to cost $210,000. This is the potential cash outflow that we would make now in order to replace the old equipment, which would then be obsolete, and therefore we would sell the old equipment. Now, of course, this new equipment we put on the books, once again, we're imagining the cash would go out at this point in time, period zero, period now, and then have an inflow impact for 6 years into the future, as we will see down below. But again, because for taxes, we can't just get the full deduction in period 1 unless there's some kind of special depreciation or something like that in place, but rather we have to depreciate it, and that's going to have a tax impact on it. So we need to take the differential between the depreciations here when we make our selling decision, or whether it would be worthwhile to sell and then purchase the new piece of equipment. Now, we think that the new piece of equipment is going to have savings to us in terms of, we can think of them as basically cash inflows or cash savings. These could be more complex to calculate when you're talking about pieces of equipment, because you might be replacing, for example, man hours or work hours, your time in terms of hours of employee work or something like that, or your own time may be decreased because now you're purchasing equipment that might make things more efficient. So you'd have to then think about what kind of savings you would get, which you can think about as the same as basically cash inflows. They're benefits their inflows in terms of the bottom line, and therefore their cash kind of method will apply to it, and we can basically use our present value calculations with them. So we're saying from X1 to X6, we're going to have these benefits, meaning X1, 75,000, which we can think of as a benefit or a cost saving or a cash inflow. In essence, we have the 78,000 in year 2, 81,000 year 3, 73,000 year 4, 70,000 year 5, and 65,000 year 6. Tax rate, we're going to say, is the 35%. Cost of capital, which we're going to use to then, once we get this down to a cash basis, think about for our net present value calculation. So let's take a look at this problem. Now, first, what we want to do then is think about the depreciation for the old piece of equipment. So let's think about the depreciation, then we'll think about the tax impact of it, and what would be basically the bottom line if we were to sell this thing, meaning if I sell the old piece of equipment, we would get the market price of the $33,000, and then we have to take into consideration the tax impact of it. To take consideration of the tax impact, we got to think about the depreciation and what it's on the books for in terms of book value for tax basis purposes. So let's do the depreciation on it first. We're going to use the maker's depreciation. We won't recalculate it this time. I'm just going to use the rates that we can apply. Now, remember, again, the tax code could change from year to year. Depreciation could be quite complex, but the baseline of it and what we're going to use here is the 5-year maker's depreciation for our example problem purposes. So we're going to say that it costs $75,000, and instead of calculating it, and remember to see kind of what the tax maker's depreciation is, you can look at prior year calculations. It's basically a double declining half-year convention with a bit of a tweak on it at the end of the years to kind of spread it out or even it out. But if you go to publication 946 on the IRS website, that's where we're at here. We're actually in the 2020, and we're in publication 946 on irs.gov, irs.gov. You can simply take these rates here. Notice it's for 6 years because of the half-year convention, even though it's 5-year property we're talking about. Half-year depreciation year 1, you can think about half-year in year 6, although year 6 is more of like a plug at the end of the time process. So we'll plug these then into the table. And so we're just going to take the 75,000 times our rates, and that's going to give us then our ending numbers here in our bottom line. So the 75,000 cost times the 0.2 would be the 15,000. That's the amount of the 75,000 that we're allocating as an expense that we get to deduct for taxes in year 1 that we're saying here. So then the 75,000 times the 0.32 is the 24,000. The 75,000 times the 0.192 is the 14,400, and so on and so forth. Allocating the cost of the 75,000 over the 6 years in this way gives us the allocation of the 75,000 over the 6 years. Now, we stopped in year 2 because it's after year 2 at this point in time. Therefore, the accumulated depreciation at this point is 15,000 plus the 24,000 at this time. So if we were to sell it, we would stop here, and that's where we would sell it. If we did not sell it, we would still have these amounts of depreciation applicable to us for the next 4 years, which would be a tax benefit. So we got to take that into consideration. So, okay, next step is we're going to take a look at the tax gain on the sale. So if we were to sell this thing, then we'll say that the sales price is the $33,000 because we said that's the market value. So if we sell the old piece of equipment, we'll get a cash inflow of the $33,000. And then we're looking at the depreciated cost, or kind of like the book value on a tax basis, meaning the cost minus the accumulated depreciation. Cost was the $75,000. We have depreciated the $39,000 already in the first 2 years and have gotten a tax benefit from them already. So the amount of the $75,000 which we paid for, we're assuming we paid for it at the beginning, that we have not yet got in terms of a deduction is $36,000 for taxes. So the $33,000 is less than the $36,000. So we have a tax loss on this. So we have a loss. So a loss is actually kind of good for taxes. That's going to result in us having a tax benefit. Remember, taxes are completely backwards. So if we have a loss, then we're going to say, okay, that means that we get a tax benefit from this because we might be able to take this loss, against income. So we got the $3,000 loss. We're going to assume the tax rate at 35% here for our calculation purposes. It could get more complex than that when you're looking at the different rates for They could possibly have different rates for the sale of the equipment and whatnot. So I won't get into that. Tax software would be helpful, but we're going to assume then the 35%. That's going to give us the tax benefit, the 3,000 times the 35% of 1,050. So we think we're going to get an added 1,050 of tax benefit due to the loss that's going to be taking place. So that means that then, let's go to the right here. The net cash inflow is going to be the 33,000. That's what we're going to get, 33,000. Remember that this whole business of us taking off over this second part isn't a cash flow basis, because we're imagining we already paid the 75,000. We're just talking about whether we got the deduction basically for it and what's going to be the tax impact, which will be the cash flow part of that. So we got the sales price 33,000, and then the tax benefit, which is a cash flow type of item, which is going to be the 1,050, and that's a benefit. So if we add those together, we're looking at the 33,000 plus the 1,050, or the 3,450 as the tax benefit. So now let's apply that out to basically the cost of the equipment. If we have the cost of the new equipment, which is going to cost us the $210,000 to buy the new equipment, which we would imagine cash going out at this point in time, times 0, that we would then imagine future payments in the future to result from that. But we don't really have to pay that amount in terms of cash flow, because we assume that we're going to get the sale of the old equipment inflow of the 34,000, meaning we're going to get the 33,000 here plus the tax benefit of 34,000. So in essence, the new equipment in terms of net cash flow for that period would be period 0 would be the 175,950. So we're imagining that after we sell the old equipment, get a tax benefit from the loss from the sale, that the new equipment's going to have a net cash outflow of 175,950 at time period 0. So then we can go on down and say, well, now let's think about, the taxes on the new equipment. If I put this new equipment on the books, then it's going to have its own depreciation. So even though I have the cash going down now, I'm going to have to depreciate it over the 5 to 6 years using the 5-year maker's rules on it as well. Now, this becomes a little bit more complicated because we have to think about the differential in the depreciation, because if I was to keep the old equipment on the books, I would still have the benefit of the depreciation that's left over. The new equipment is more expensive, and we have the front line or front year depreciation, which is typically a bigger benefit. So we have this differential depreciation problem. So let's calculate the depreciation on the new equipment starting now at this point in time going forward, years 1 through 6. We have the same rates, which we're going to be pulling from our table over here. So we're just pulling these same rates because it's the same maker's table, the 20, the 32, the 19, and so on. That would result in the depreciation for periods 1 through 6 then of the 42,000, which would be the 210,000 times the 20%, the 210,000 cost times the 32%, 67.2, the cost times the 19.2%, give us the 40,320, and so on and so forth. So these would be, and if we add those up, of course, we would be allocating the cost, which we're saying that we're actually going to pay cash for in period 0 of the 210,000 over the 6-year time period, which would be the 210. Now, what we want to do then is take the differential between what would happen from this period 0, up to the 6 years from doing the new thing, buying the new equipment, to us not buying the new equipment and keeping the old equipment. So that means we have to match period 1 here at this point in time starts at period 3 when we're thinking about the old equipment, because the old equipment we're selling after 2 years. So after 2 years, 3 on is the current period. So we are at time period 0, which represents in terms of the depreciation schedules, time period 1 for the new equipment, if we choose to do that, or time period 3 for the old equipment. So we need to be matching up the 42,000 that we could get to the 14.4 and so on going down. So if we line these up, there's the new asset, here's the old asset that we're tying out, right? So we got the 42, the 67.2, and so on here. And then we're skipping 15 and 24, and we're starting at the 14.4, the 8.640, the 8.640 here, so that we're lining up the proper periods. Now, of course, there's nothing on the old equipment for period 5 and 6 because those have already been depreciated. There's only 4 years left. Then we're taking the difference, which is what we want in our decision-making process. We want to take the difference between them, which would be this. So we got the 42,000 minus the 14,400, 27,600, the 67,200 minus the 8,640, 58,560, 40,320 minus the 8,640, the 31,680, the 24,192 minus the 4,320, the 19,872. We're then going to apply the tax rate, which we said was 35%, 35% on the tax rate. So we're going to have the tax benefit. Also note that we will do this a couple different ways. So I'm going to do it in this format this time, and then we'll see it in another format, which is similar to what we've seen in the past. It'll look more familiar, just to show you that you want to see it, how it can be lined up in multiple different ways so you can work with other people that might do it in multiple different ways instead of just kind of locking into one system. It's easier to lock into one system for test questions or something like that so that you could go right to how you want to set up the table. That makes sense. Whatever you think is most efficient. But you want to see them multiple different ways so that you can work with other people and present the data in multiple different ways to whoever, whatever you think will get your point across to whoever you're talking to, or that you can understand whatever they're saying as well. So in any case, we got the 27,600 times the 0.35. That's going to give us the 9,660 and the 50. Whoop, something funny happened there. Hold on a second. Let me see if I can undo that. I can and did undo it. So now let's do this again. So now we've got the 58,560 times the 0.35 gives us the 2496 and so on and so forth. So if we were to add that down, the differential is going to be this column. And now we took into account our tax benefit for the added depreciation that would happen, of course, with the new asset. So if we bought the new asset, we would have the difference in depreciation, which would be a tax benefit net that would be there. Then we could think of the cost saving side of things. So these inflows that we have here, the 75 or the more efficiencies that we would have, which we can think of as equivalent to basically cash inflows, are going to have a tax impact as well. So if I line those inflows up at the 75, the 78, the 81, and so on, same stream, we then would take the amount that we would get to keep in this case. So in other words, if we took 1 minus the 0.35, because the tax rate is 0.35, then the government's going to take, we assume, 35% for their silent partner portion, and we're going to get 65%. So of the savings or cash inflows, we're going to be keeping 65% after taxes, because the rest is going to the government. So we're going to say on the cash inflow after taxes, 75,000 times the 0.6 times the 0.65, 48,750. And did I say 75,000? Yeah, that's right. And then 78,000 times the 0.65 is going to be the 50,700, and so on and so forth. So that gives the 287,300. So then if we take the tax benefits that we had, net tax benefits, the net depreciation, and we pull that in this column, we got that from the calculation up top, up here. So this is the tax difference on the depreciation schedule that we're putting here, and then the savings after taxes that we pulled over here from the inflows. We can add those up, and we get to our total tax benefit, meaning the 9,660 plus the 48,750 is the 58,410. Let's do one calculation just to see it. The 2496 plus the 50700, 71,196, and so on and so forth. And there we have our benefits. Now I put this one over here just so you can kind of see that ties over. Now this then is what we can then use to apply our net present value calculations to. This would be basically our flows that now we can apply the net present value at the discount rate. However, before we do that, let's do it in the way that we've seen it before. So we're going to recalculate this again, but this time put it in the format that we've seen in our prior practice problems, just to see it in that way as well, which might click it together a little bit and let you format the tables a few different ways. So let's pretend we have the earnings before depreciation and taxes. These are our inflows, the 75, the 78, the 81, the 73. We could think about them as savings or as income, basically cash inflow in essence, or savings. And then we have the incremental depreciation, which is the depreciation of the new asset minus the depreciation of the old asset. This is the same table we calculated before, lining up the depreciation schedules from this point forward and seeing the differential between the two. That differential we're going to think about as the depreciation down here. So so we'll take then, because that's going to be the difference that we want to be comparing. So if we take the 75,000 minus the 27,600, we get the 47,400 for the earnings before taxes. 76,000 minus the 58,560 is the 19,440. The 81,000 minus the 31,680 is the 49,320, and so on and so forth. Then we can apply our taxes now as we did before, rather than applying them to like line 1 and then line 2 like we did on the tables up top. We can apply them now that we've combined them together to one component here. So we can take our trusty calculator and we could just be like, all right, now we got the 47,400 net times the 0.35. That would give us the 16,590. We could take the 19,440 times the 0.35. That gives us our 6,804, and so on and so forth. Then we have our earnings after taxes. The 47,400 minus the 16,590 is the 30,810. The 19,440 minus the 6,804 is the 12,636. The 49,320 minus the 17,262, 32,58, and so on. Then we're going to add back the incremental depreciation, because the only reason we took it out is because it had a tax impact, which is a cash flow item, even though it itself is an accrual item. So we add it back. So then if we take the 30,810 plus the 27,600, that gives us the 58,410. The 12,636 plus the 58,560 is the 71,196, and so on and so forth for the cash flow. So once again, now we have our cash flow bottom line. We can apply the net present value calculations too. This bottom line down here should tie out to what we came up to in this format as well. So these two tables are kind of mirroring or getting us to that cash flow, the bottom line of it, or adding it up, the 348,200, and this ties out to, let's just add it up and double check it, the 58410 plus 71196 plus 363,738 plus the 54405 plus the 53967 plus the 46484 is the 348,200. Now let's apply out our net present value using the cost of capital, which could be called the hurdle rate or the required rate of return, the discount rate, 12%. That includes what we want to receive in a gain, and therefore anything with regards to our net present value that is 0 or above includes that 12% in it, and therefore we might accept the job. Let's do it horizontally first. We got the cash flows, which we're just pulling over the cash flows that we got from here down into our table, present valuing them, noting that we have the number of years up top to make the formula easier. Then this 58,410 present valued at 12% discount rate for one period would be the 52,152. And if we look at the formula for that, note that if you want to see this in terms of present value, like a formula format, done with a formula or done with tables, look at the prior section where we spend a lot of time on that. These longer problems, it would be difficult even in a test question to force you to use just a mathematical calculation, and even tables would be difficult because it could take more time to do so. But take a look at the prior presentations to see how we can do that in those formats. Using Excel, it would look like this: negative present value of the rate, which would be B19. In this case, it's an absolute reference. It's referring to that 12%, and it's an absolute, so when we copy it across, it'll copy it across easily, comma. Number of periods is 1, which is not hard-coded, but rather using a formula, which is referring to the 1 up top, so we could copy it, comma, comma, because it's not an annuity, but present value of 1, and then we take the future value, which is the 58,410. Copying that formula from this cell to this cell, the 71,196, if we present value at the 12% discount rate, is 56,757. That formula then, negative present value of the rate, same cell here, B19, because absolute reference, comma. Number of periods is now 2. Rather than typing or hard coding, it's coming from the cell up above. You can see it change from Z10 to AA10. And then comma, comma, we have then the future value, which would be the 71,196. And once again, you could see the cell change because it moved over from Z11 to AA11. So then if we moved on doing this process, period 3, the 63,738, present valued at 12%, 3 years would be 45,367. The 54,405, present valued at 12% for 4 years, 34,575. The 53,967, present valued 5 years at 12%, 30,622. The 46,484, present valued at 12% for 6 years, 23,550. Adding the present values up gives us total 243.24. Now we're going to compare that to the outflow, which was 175,950. Now I'm going to scroll all the way up to find that because it's a little tricky. Remember that we're saying the outflow is 210,000 for the new piece of equipment, but we said that we can sell the old equipment, and we did this whole calculation up top, way up here, where we said we could sell the old equipment and take into consideration the tax benefit of that sale in this case. So really, after that is taken into consideration, the net outflow in period 0 for the new equipment after the sale and cash benefit of the old equipment for the tax benefit is 175,950. So that's the outflow we expect to be happening then in period 0. So scrolling back down, we're going to say that's the outflow, 175,950. So the 243,724 minus the 175,950 is a positive 67,74. Note the 175,950 does not need to be present valued because it's at time period 0 that those cash outflows are happening. Because this is positive, that means that we cleared the 12% even if it was 0 or above, so we might then take on or purchase the new equipment in that case. Scrolling back down, we could see this in a vertical fashion, which would look something like this. We got periods 0 through 6. Then we have our cash flows starting with the negative 0 outflows at the 175,950. Then the inflows lining up just as they would, but this time in a vertical fashion as opposed to horizontal. If we were to present value, and I will present value period 0, even though we get the same number, so that we have the same uniform calculations in the outer column and can then copy them down if we were to use Excel. Negative present value of the rate, which is going to be the 12%. Notice it's an absolute reference by the dollar signs, comma, number of periods, which would be 0, not hard-coded, but rather using a formula so we can copy it down, comma, comma, future value, 175,950, using a formula. Then if we copy that down, the 58,410 discounted back at the 12%, 1 year would be 52,152. Formula, negative present value of the rate, same cell, you can see, comma, number of periods, which is now 1 because it went down from 0 to 1 here. You could see the cell reference going from AH4 to AH5, comma, comma, and then we got the future value, which is now the 58,410 represented with a cell also moving down. You could see from AI4 to AI5. Continuing this process down, the 71,192 discounted at 12% for 2 periods, 56,757. The 63,738 discounted 3 periods at the 12% gives us the 45,367. 54,405 discounted 4 periods at the 12%, 34,575, and the 53,967 discounted at the 12%, 5 years, 30,622. Finally, the 46,484 discounted 6 years at the 12% is the 23,550. Adding those up, we get once again to the 67,74, just like you knew we would, because we did the same thing, but in like reverse column order, reverse the table. You could see what we did. We switched it up, but made it the same at the same time. So the total down here, if we were looking at this, the inflows and the outflow without time value of money, 172,250. If we take into consideration time value of money, 67,74. But this is deceiving, remember, because this 6774 doesn't mean that's what we got after simply like inflation, the value of the dollar declining, because even if this was 0, we would have got the benefit of the 12%, which we assume includes the rate of return that we want to get, meaning, the cost of return possibly matching the opportunity cost of something else we could invest in. So just be aware of that. That could be a little deceiving. Now, the fact that this is above 0 is good. The further from 0 means the further we have cleared the 12% in general. But if we want to know what the actual percent is, that would be the internal rate of return, which could be calculated as equals the IRR, and then take the values from period 0 to 6, or in other words, the negative 175,950 outflow on down to the 46,484 inflow. That then giving us the IRR, the internal rate of return, of 25.29. The internal rate of return being the rate at which the net present value calculation will be 0. So if we did this net present value calculation using the 25.29, we should come up to an end result of 0. So your thought process being, if this is positive, net present value is positive, that's good. We cleared the hurdle rate, might take on the job. Then we want to know what the actual rate is, because the fact that it's positive is good. What would the actual rate be, so that we might compare it against other projects? IRR is that calculation, 25.29% in this case.